When you're thinking about taking out your first mortgage, the most important thing with your mortgage is the rate that you pay. So it's important to do a lot of research at the beginning and look at the various options, make a lot of applications to a lot of different lenders to make sure that you take out the mortgage that's financially in your best interests in the long term. There's absolutely no connection between where you save your money and where you take out your mortgage. Obviously, if you have a relationship with the bank, you might approach them when you make a mortgage application. But the most important thing to do is to approach a number of different lenders, because there can be huge differences in the cost of a mortgage from one lender versus another. So for example, if you're borrowing €270,000, the difference between the most expensive and the cheapest lender over a 30-year mortgage could amount to over €50,000. So you could save yourself a considerable amount of money by checking all your options first. You can log on to our website at ccpc.ie and we have a mortgage comparison tool where you can put in the information in relation to the type of mortgage that you want, so how much you want to borrow and over what term, and you can see what's available on the market, and then from there you can start making applications to different lenders. That really comes down to a personal preference, but some of the things you might want to consider when deciding whether to go with a fixed or a variable rate mortgage would be how much certainty you want to have in terms of your repayments. So for instance, if you go with a 2-year fixed rate mortgage, you know that your repayments won't change at all for those 2 years. And that might be important to you, when you initially take out your mortgage. With a variable rate mortgage, it could go up or it could go down. So it really depends on your own circumstances, what plans you have in the future. So if you're planning to have children, you may want to have certainty in terms of what your mortgage repayments would be. You've probably seen a lot of advertising from lenders with cashback offers if you take out a mortgage with them, or maybe a contribution towards your legal fees or towards a valuation. And these can be really attractive because when you buy your first house, obviously every cent counts, and you really, might be attracted by the money at that stage. But really the most important thing with the mortgage is not any of the special offers or the freebies, it is the actual rate of the mortgage, and the lower the rate you can get, the less you're going to spend over the life of the mortgage. If you've had problems with loans in the past, the first thing that you should do is get a copy of your credit record so that you can see what information a lender is going to see when they go to check your credit record. It doesn't mean that you are never going to get a mortgage, and it doesn't mean that you'll be automatically excluded from a mortgage, but what it does mean is that the bank will want to see that you are able to make your repayments, and part of that assessment would be to look at your credit record. You may not be able to get a mortgage right now, but you may be in the future. So if you've been renting for the last few years, your lender will look, when you make an application, at all of your outgoings and all of your incomings as well. So what they'll want to see is that you have capacity to repay a mortgage. So if you've been paying rent, then they would look at that in terms of where your money generally is going, and that will help them to assess how much you can actually afford to spend on your mortgage repayments. When you're a first-time buyer, you'll need a minimum of 10% deposit, and your lender will want to see where that money has come from. So you may have been given a gift of money, or you may have assistance from somebody in terms of getting your deposit together. But the bank will also want to see that you're able to manage your money, and showing a savings record is important in that context. So if you're thinking about buying your first home, the first thing you need to do is to work out your budget. So how much money are you going to need in terms of a deposit, and also other costs like legal fees and stamp duty. You then need to start saving for your deposit, which would be a minimum of 10% as a first-time buyer. Once you've done that, you can start thinking about applying for a mortgage. Before you make an application, you should really look to see what rates are available in the market. So you can log on to our website at ccpc.ie and see what rates are available, and then you can start making applications. Once you've had your application approved, you'll get approval in principle. At that stage, you should contact a solicitor and then you can start house hunting. And you'll be in a position then with your approval in principle and your solicitor that if you see a house that you like and if your offer is accepted, you'll be able to move quickly in terms of closing the deal and getting the keys to your new house.